All right, perfect. So welcome to tonight's royalty training. We got a packed one for you. We're talking about how the W-4 can help you build wealth. And even if you have been in my econ for some amount of time, understanding this strategy is still going to be a game changer for you, first and foremost. But secondly, you got to understand that other people that you're around can be benefiting from the W-4 strategy as well. And that being said, I want you to stick around to the end because it definitely shows you how the W-4 strategy is really a wealth form. So many people just think it's just a form of getting extra money. That's a part of it, but we want you to be strategic with that money. We want you to give that money some assignment because money is just a seed. It's where you plant it that determines the harvest. And if you never plant it, then there will be no harvest. So you want to be investing in something. You want to be putting it towards something that gives you a rate of return, even if that means paying off debt. And I'll get into that, but just understand the power of the W-4. And this is what a lot of people miss out on by not understanding that form, when in all actuality, a lot of people are leaving money on the table by not understanding that form. So I'm gonna get into the presentation. Like I stated, I'm gonna turn our camera off just because I want you to get the full screen, the full breakdown.
Are you recording?
Yes, it is already recording. Recording is in progress. And you're going to get a double whammy on the W-4 presentation. So you're going to get the first version is going to be the slide. Before I start it, I want to see in the chats if the screen can still be seen. Before I get going, if the screen can still be seen, because I wanted y'all to see these slides for a couple of different reasons, but I'm also going to take you to the website. There have been some changes on the website, so I want you to see that as well. But give me something in the chats if you can still see my screen. Yes, I got 2 yeses that came through back to back. All right, perfect. And if you see somebody popping up right there before me, do just like that and let them in. All right,
I got you.
And minimize that. Okay. All right. So we're talking about the W-4 and the W-4 calculator. And this is a tool that's provided by the IRS if you don't already know. Initially, when we first got started with my econ, we were filling out the W-4 form, and basically we were filling it out via paper. Well, a couple of years back, what they did was added an estimator, also known as a calculator, and it really started to minimize some of the guesswork. A lot of people were terrified to fill out the W-4 because they first wanted to know, well, if I adjust my W-4, am I going to owe? Am I going to owe at the end of the year? How much am I going to have to pay back? That fear kicked in. So sometimes they may want to adjust it for half of the year, then change it back. But when the W-4 calculator came out, what it does was minimize that fear of uncertainty because it made it plain. And I'll show you how. Because once you do put all your numbers into the calculator, now you'll know what to expect at the end of the year. And I will say this, the more accurate you are with the system, the more accurate the system will be with you. So let's talk about the W-4 calculator. So the W-4 calculator protects you against having too little taxes withheld and facing an unexpected tax bill or a penalty at the end of the tax time next year. So this is what I'm talking about. It protects you against having too little taken out or having an unexpected tax bill. The average refund is $3,000. So you may prefer to have less tax withheld up front and receive more in your paycheck, which is what my econ recommends. Let's proceed. So here's a disclaimer. My econ does not guarantee you will receive an increase in your check by adjusting your form W-4. And if you listen to us talk about this, we always say, depending on your scenario, because it's not a guarantee. Everybody's scenario is different. However, over 100 million Americans overpay in taxes. And as a result of it, they tend to be likely to get an increase in pay. So the results will vary based on each individual's unique financial situation. So just make that understanding. Did you have something you want to say? All right, perfect. So this is the family status of this example. And I'm going to go through this quick because I still want to take you to the actual form live, but I really want to go through some of these because this is a great example and a way for you to learn the W-4 because this slideshow is available in the back office along with talking points. And this is actually a good presentation tool for people you may want to introduce into the business, and I'll tell you why.
All right, so the family status for this particular situation is married, filing jointly, $105,000 in household income. $50,000 of that is the husband, and the queen is $55,000. 2 dependents, ages 7 and 10, and child care expenses are $6,500 a year.
Absolutely, and this is the Johnson family. So required information for the W-4 calculator, which is important. It's important that you come when you're filling out the W-4 with your most recent check stubs. Like I said, the more accurate you are with the system, the more accurate it'll be with you. So if you come with a 2-week-old, 1-month-old check stub, it's not going to line up with the dates that are current today. So I really want you to understand the importance of having the most accurate check stub. I can't stress the importance of that enough. The more accurate you are with the system, the better your results. So you can predict or project what's likely to happen when it's time for you to actually file taxes. So in this example, Robert Johnson has $50K a year. Kim Johnson has 55 a year, as we stated, and this is just a representation of their check stubs. Now, the tax withholding estimator, let's talk about it. See, if you open up the Google search in the engine browser, this is how you access it. You can type in W4 calculator in the search bar, and you can click search, and then you can click tax withholding estimator in the IRS. And it looks very similar to this, you know, and then you'll know if it's the right one because you'll see the tax withholding estimator. So that's how you go about accessing your calculator if you want to pull it up for yourself. All you got to do is Google exactly what this says, W4 calculator in the search bar, and then you'll click the one that looks just like this, that's boxed in red. Now, review tax withholding estimator page, because this is one of the first pages you'll go to, and it gives you the overview of what to expect. So you want to read the recent tax law changes for taxpayers who itemize. It always be something different right here. So just read whatever the update is and see if it's applicable to you. And you want to read that before you begin. Then you click use the tax withholding estimator. So that box down at the bottom, there's that button right there that's boxed in red. That's exactly where you enter into the tax withholding estimator. This is where it all gets interesting. So about you, that's where you start, because this is all about you. So you start with yourself. About you is the information that best describes how you anticipate filing your tax return. The Johnson status is married, filing jointly. No one else can claim the Johnson as a dependent on their tax return. So in this about you section, and it's changed a little bit, so I'll show you how that looks, just so you can be up on the most recent changes that have already taken effect. But for the most part, it's very similar to this still. So it says 1 out of 5 filing status, they're married, filing jointly, and down here, may another taxpayer claim you as a dependent on your tax return? The answer to that is no. Real simple, straight to the point. Then it goes to the second screen. The Johnsons will be claiming their 2 children as dependents on their tax return. Both Mr. and Mrs. Johnson will hold a job with federal income taxes withheld. Both expect to hold 1 job each, and the Johnsons do not receive pensions. And it's laid out like this because that's the order of operation. So right here it says, do you claim dependents on your tax return? The answer is yes. How many? 2. The income, do you or will you or your spouse hold a job this year in which the paychecks are taxed federally, basically put. So that being said, they say yes. How many jobs? 1. How many jobs will your spouse hold? 1. And then from there, they don't plan to receive a pension, and they bubble in that no. So as you can see, everything is bubbled in step by step, and you fill it out based on your scenario. Yours is going to be different. If you're not married, filing jointly with 2 kids with the same income that they have, then yours is going to be significantly different. So just fill it out based on your scenario. Then it takes you to the next screen. The Johnsons do not have any other sources of income and tax payments. The Johnsons do not fit any of the demographics listed. So basically, this whole page will be skipped. This whole page will be skipped because nothing fits their scenario. But I want you to look at each sentence. Each sentence that asks a question, you'll see that it's a question mark at the end of it. You can always click that question mark on the right side to determine whether or not that's something that fits your scenario. It'll elaborate a little bit on what that line means so you can have an understanding on whether or not this is applicable to you. If not, proceed. It's okay for this section to be left blank. So this section will be left blank based on the Johnson scenario. Then it goes to the income and withholding section.
All right, income and withholdings is the income and withholdings for each job you earned income from this year. Mr. Johnson, he plans to hold his job the entire year. Mr. Johnson is paid twice monthly, and most recent pay period ended February 19th of 2021.
So as you can see, they filled it out accordingly, your job. And then it's yes, based on that scenario. They get paid twice monthly, and then they have the date right there. So you just fill it out according to your situation, and the check stub is what comes in handy right here when it comes to that date. So just understand that. Pretty simple, straight to the point. Now, on this one, Mr. Johnson earns $50,000 per year. Mr. Johnson does not expect any bonuses. Year to date, Mr. Johnson has paid $524 in federal taxes. From last check, Mr. Johnson has paid $131 in federal taxes. Mr. Johnson does not contribute to the 401k or other cafeteria plan. So each line lines up with everything I just listed. The $50,000, he does not expect any bonuses. The amount that has been taken out year to date, the amount from the last pay period, and the last ones that we said no to about him contributing to the 401k or the tax cafeteria plan. So we'll proceed to the next section.
All right, so let's talk about Mrs. Johnson. She expects to have her job all year. So on the very first option, we put yes. Mrs. Johnson gets paid twice monthly. Mrs. Johnson's most recent paycheck period ended February 19th of 2021, and she earns $55,000 per year. She does not expect to receive any bonuses. And again, you see everything is lined up on the right side of your screen. This is exactly what the Tax Withholding Estimator tool is going to look like, and we're going to show you that live when we finish.
Absolutely. So fill it out based on your scenario. So year to date, Ms. Johnson has paid $624 in federal taxes. So you'll see the first box, year to date, $624. From last check, Ms. Johnson has paid $156 in federal taxes. So from past pay period, you see the 156, and then Ms. Johnson does not contribute to the 401k or other cafeteria plan, so she would click next.
And you guys, if you notice, this is all of the information that's coming from your paycheck stub. So all you're basically doing is copying the information over. That's why it's so important to have your last paycheck stub in front of you and to fill it out with accurate numbers.
100%. Adjustments to income. This is the screen that talks about the adjustments that will have a significant impact to your tax obligation. The Johnson family doesn't know, so they opt to see adjustments. So right here, when you get to this screen, you can click to see adjustments to see what options actually open up. Because if you don't know, it's important for you to expand it to see if it fits you. So when it expands, you'll see student loan interest, educator expenses, deductions, etc. But the Johnsons do not have student loans, education expenses, or IRAs. This is a continuation of that same page. So right here, it says the Johnsons do not have health savings, account deduction, moving expenses, alimony paid, penalty for early withdrawal, or business credits. The Johnson family does not have any adjustments to income. So they just opened it up to see if they did, but come to find out they don't. So they leave this blank and just click next.
Absolutely. Now let's talk about deductions from income. The Johnsons qualify for a standard deduction of $25,100. The system will actually tell you that. So if you're looking on the right side of the screen, what they've entered in thus far qualifies them for this $25,000 deduction, okay? The Johnson family does not have more than $25,100 in itemized deductions. So the Johnsons will take the standard deduction. You want to explain the two?
Absolutely. So everybody either takes a standard deduction or itemized deduction. Most people, everybody qualifies for a standard deduction. Itemized deduction is based on charitable giving, sometimes donations, sometimes church-related stuff, sometimes medical-related stuff, sometimes school-related stuff. But the goal of itemized deduction is that it has to be more than what the standard deduction allows. If it doesn't exceed what the standard deduction number is, then it just makes more sense for you to take the standard deduction because it minimizes your taxes the most. In this case, they didn't have any itemized deductions. But sometimes what people do is they'll take itemized or say that they're itemized just because they donated a little bit. And truth be told, if it didn't exceed the standard deduction, then you didn't. You end up taking the standard deduction, hopefully. But if you did end up taking an itemized deduction, you hurt yourself because you want this number to be larger because this is what lowers your tax liability. And that's basically just a fancy way of saying it allows you to pay the less taxes legally so you can keep more of your hard-earned money. So standard deduction is what they chose based on their scenario, and then we'll proceed to next. Tax credits. The Johnsons qualify for tax credits for their dependents. Tax credits subtract directly from tax obligation, another thing that lowers your tax liability. Click see tax credits. So they click to see tax credits, and very similar to the adjustments to income, this drop down will expound to open up some other things. It says that the Johnsons have 2 children under the age of 17. The Johnsons have 2 children that qualify for child care tax credit. So right here, they put 2 children here, and then under the child dependent tax care, they put 2 dependents there as well. And it was proceed to the next screen. Right here it says the Johnsons paid $6,500 in child care. So at the top box, it says enter an estimate of your work-related child and dependent care expenses. And basically you can click that question mark to see what applies to you, but they want the child care to be based on either you going to work or looking for work in order for it to qualify for a child tax credit. Then it says the Johnsons do not qualify for the earned income tax credit because they make too much income. So it's a certain tax bracket that you have to be under, or threshold that you have to be under. Being that one makes $50,000, the other makes $55,000, a total of $105,000, they don't qualify for the earned income tax credit in this scenario. However, you may, and the system will let you know based on the numbers that you put in. The Johnsons do not have foreign tax credit, educational, retirement savings, or homeowner credits. And of course, you can hit the plus sign to just expound it to see if that's something that you can benefit from or not. But in this case, we leave it blank, we proceed. The Johnsons do not qualify for elderly or disabled business, alternative minimum tax, energy efficient vehicles credit. So they leave that blank. This is still another section of the same page that we were just on. So it's not any new page. This is all on that same page. But for the slide's sake, it was better to break it up in this way. So we click next. And then it takes you to the results, but we're going to throw in a little caveat. And this is why I said that this is great for people who may not be inside of my econ just yet, because if they see this, then they'll realize, wow, I am leaving some money on the table. I am hurting myself by not understanding how this whole W-4 form works, and I prove it to you. So basically here, what we do is on the results page, it says the results will show if you owe or receive a refund. So this is where all of the curiosity or the fear of, am I gonna owe at the end of the year? When the IRS came out with this form, I was excited. I actually felt like the IRS did the people a favor. Some people was running away from using the calculator at first, but once you truly understand it, you realize, oh, now I know what to expect. It's really not any guesswork. You know what to expect in terms of tax time if nothing else changes. So in this scenario, on this results page, it says the Johnsons will have a tax obligation of $33.93, and that's being paid throughout the year. The Johnsons will pay $6,888 in taxes and overpay by $28.95. So they'll pay a total of $6,888, but their obligation based on their scenario was only $3,393. So that's an overpayment of $28.95, also known as a refund. So when you see the overpayment, that's the refund. That's typically what they would get back in the form of a refund based on their overpayment. So I hope y'all understand that the tax obligation, the amount that they were supposed to pay based on their situation, was only $3,300. However, throughout the year, because their W-4 was what it was, they actually would get a refund for $28.95. So just understand the difference there. Now, in this slide, they actually took it a little bit further. They said the Johnsons learn about the advantage of investing and owning a home-based business. They decide to invest $28.95 into their 401k. So the $28.95 that they would have got into as a refund, they decided to invest that into their 401k once they learned about income shifting. The Johnsons click on the income and withholdings link. Mr. Johnson changes his answer and contributes $28.95 to his 401k. So they made it to the end, and they learned about the income shifting strategy, and they said, let me revisit it and play with these numbers a little bit. And instead of getting this as a refund, let me put this money to work. So it asks you, did you or will you contribute to the tax deferred retirement plan such as the 401k? At first he said no. In this section, he decided to say yes, based on the fact he knew he was going to get a refund. He wasn't really too concerned about the refund. He wanted that money to be somewhere where it can grow once he learned better. So it said, how much do you anticipate contributing per year? So he just put the number that would have came in a refund. It said, did you or will you contribute to the HSA, FSA, pre-tax child care? So in this one, he still kept it at no. But watch what happens. It says adjustments to income. So now we're back at the adjustment to income screen. It says the Johnsons learn about the advantages of a home-based business and decide to get started in My Econ.
The Johnsons clicked on the adjustments to income link. The Johnsons estimate they will have $5,000 in Schedule C business losses.
So understand this, when you're inside of My Econ, we teach you certain strategies. Them investing in the 401k save them money on taxes. So a lot of times people think about tax deduction, but sometimes your investments or you putting your money in the 401k can be a tax deduction by itself. In this case, not only did they put money towards the 401k, they also realized, oh, by me having a business, I may qualify for $5,000 on Schedule C business losses. Now, $5,000 is not a big number when you think about a full year. And this is February based on the time of this scenario. So they still have about 10 months left in order to make sure that they can qualify for the $5,000 in tax deductions. Now, we'll do some more trainings on tax deductions, but this is a key piece of why we want you to get an understanding of My Econ, better your credit, because a lot of people came so they can get access to the DIY credit system. Understand the W-4 strategy, because a lot of people can benefit from the pay raise, and we're going into detail on how that works here shortly. But more importantly, when you decide that you want to use this and grow this as a business, what happens is you position yourself to get tax deductions. Tons of tax deductions. 5,000 is playing it small. Most people are able to write off, 5 figures worth of tax deduction, but it all boils down to you doing business. It all boils down to you making sure that you're sharing the information with others who may also want to join. So that's that. And at the bottom, it says see publication 505, which has the full list of adjustments to income, including Schedule C loss, which is what the Johnsons are claiming in the box above. So basically, they're claiming the $5,000 in this box down here at the bottom where it says certain business credit, but the publication 505 is what elaborates on why that's even a possibility. It lets you know that self-employed has the ability to adjust their W-4 based on this information in their publication. So that's another powerful piece to the puzzle. So it says the Johnsons click on the results tab after making the change to their 401k contribution and adjustments to income to see what changes, if any, occurred. By contributing to their 401k and starting a home-based business, the Johnsons now have a tax obligation of $3,045. The Johnsons picked up an extra $948 by making these 2 changes. So by doing that, they lowered their tax liability a little bit more. Now we're going to show you the power of you getting a refund, because once you get a refund, you have the ability to determine whether or not you want to A, get the refund, B, do something with it, like put it in a 401k, or start getting some of that money throughout your paychecks going forward. And that's what we call the pay raise, because that extra cash flow can start going towards your debt, going towards your investments, going towards your savings, your emergency fund, whatever you're saving for. Now, as you're listening to this, because we still got a lot more to cover, I want y'all to start writing down any questions that you may have towards the end, because we got a lot to cover, and I want to make sure we get all the way through it. So here are the income shifting results. Because the Johnsons learned how to income shift with 2 simple strategies, they improved their finances in 3 ways. Number 1, the Johnsons redirected their tax overpayment into their 401k. Number 2, Mr. Johnson's employer matched the 401k dollar for dollar. Number 3, investing into their 401k and starting a business lowered their taxes by another $948. So the total income shift in this scenario is $6,738. That money would have came in a refund, but now went to a place where it can make it tax deductible. Keep in mind, they never lose this money. It lowered their tax liability and is going towards their future in the form of investments. What's beautiful about it is this particular employer matched. So now that's money he would have been leaving on the table, because had he not been throwing anything towards his investments, the employer wouldn't have matched it. But this company matched dollar for dollar. So he put in $28.95, and the employer said, all right, I'm gonna put in 20. You believe in your future, you believe in your retirement. Right. I'm gonna invest in you too. You invest in yourself, I'll invest in you. That's pretty much how that works. I'm sure that's how the conversation went, something like that. And they lowered their taxes by $948. And when you add that up, that's $67.38. That's the total income shift that came from this. Now, this is how the slides work. So what I want to do next is go into the actual W-4. Now it's changed a little bit, so it may be some things that we are not all the way familiar with based on some of the changes. So you may be learning as we're learning, but we want you to see in real time how it looks. So this is how the estimator looks when you first get here, and some of these screens look familiar, but let's go.
All right, now the way that you get here, you guys, is irs.gov. If you didn't know, irs.gov, and then you click on the Form W-4 and you will see the Tax Withholding Estimator. The very first question is all about you. What is your filing status? Single, married, filing jointly, married, filing separately, head of household, qualifying widower. If you don't know, okay, you can always click the question marks. They have question marks as you go. For example, head of household. A lot of people used to think the person who makes the most money in the marriage is considered head of household. That is the furthest from the truth, you guys. Read here. Generally, you may claim head of household filing status on your tax return only if you are unmarried and pay more than 50% of the cost of keeping up a home for yourself and your dependents or other qualifying individuals. If you are married, you can't file head of household. If you are unmarried, but you don't have any dependents, you cannot file head of household according to the IRS. So if for whatever reason you are confused about your filing status, click the little question marks, and you actually can click those question marks all throughout this tool if something is confusing to you.
Absolutely. And we're going to mimic the same example. So this is going to be an example of the Johnsons again. I added up some math because their filing was in February, and now we're in the month of October. So the numbers may be a little different, but nonetheless, I'm going to do married filing jointly just to kind of mimic what we've already saw. But of course, you'll fill it out based on your scenario. So married filing jointly, then it pops up down here. Do you or will you or your spouse have a job or a pension that regularly withholds federal income taxes from your paycheck? So the answer is yes. This job will take out money regularly in the form of federal expenses. Select any that apply. We'll leave this blank, just like we did in the initial example. None of these apply to their scenario. So we'll just click next.
So you guys, if you notice, after you answer one question, then it populates either the next part of the question or the next question. Mm-hmm. You can't go wrong with filling this out. It's literally going to populate as you go, okay? Let's talk about the income and withholding. Enter information for each job and or pension you will earn income from this year. All fields marked with the asterisk are required. How many jobs and or pensions will you and your spouse have this year in which federal income tax is regularly withheld? Include past, present, and future jobs and pensions. The first one has been added for you. Guys, this is the IRS. They want to know everything, okay? Right. They want to know every dollar that you have coming into your household, how many jobs you work, how much taxes you're paying, got any side income, getting retirement, you got a grant, right? They want to know everything that's coming into your household. So for the first income, we're doing the husbands. It is $50,000.
All right. So when they say how many jobs, this is the spouse and you.
Oh, yeah.
So we're going to do 2 right there. And this is the new part. So I'm hoping that this is exactly what they're asking. At first, it didn't look like this, but we're putting 2 because they said you and the spouse. So it'll be 2 jobs, 1 each. If we got to go back and change it, then, we learn together. My first income source is, we're going to say, we can do hourly or salary, but I guess we could do.
Let's do hourly.
We could do hourly. So it really don't matter. All right.
Select what best describes when you or your spouse earn income from this job.
Our year, January.
Sorry.
Yeah. Our year, January through December 31st. I currently hold spouse. I had my spouse earlier this year. I do. Okay, so we're going to do all year. So we're assuming that they started and they worked this job all year. This part is new. So just, fill it out based on your scenario. But pretty much it's gonna still line up the same. How frequently are you and your spouse paid? And honestly, they trying to make it even more exact, because for them to ask whether it's salary or hourly or Social Security or pension, they're trying to get down to the nitty gritty so the numbers are even more accurate. So that being said, it says, how frequently are you and your spouse paid? On this one, we're gonna do twice monthly, because I believe that's how it was for them last time. It was either every 2 weeks or twice monthly, but we'll just do twice monthly. Using your spouse's, using your or your spouse's most recent pay stub, when did your or your spouse's most recent pay period end? So I'm gonna just choose the last Friday in September, because it's currently the 6th. So we'll take it back, and we'll say the pay period ended on September the 24th. Select the option that best describes your spouse, you or your spouse's current situation. Me or my spouse last paycheck was a good representation of how much I or my spouse earned on the average pay period. Yes. Now, if your checks vary from week to week, averaging 2 to 3 paychecks will provide more accurate picture of how much you or your spouse make. But we're gonna say that it's an accurate depiction of what you make on the average. They're really trying to get down to the nitty gritty to make sure their numbers are as close to accurate as possible. So we're gonna say that everything is, typical. Enter the wages per pay period. Now, for the wages per pay period, I'm gonna have to do some math, because I didn't put wages per pay period. I just put that they earned $50,000 for the entire year. So we'll start. Did you say you want to start with the husband or the wife?
The husband.
All right. So per pay period. So if he makes $50,000 for the year, that's about $2,500 per pay period if it was 10 months. So we're gonna just say about $2,000 per pay period. I know that number is a little off, but roll with it. Enter wages earned year to date. It's October, so if it's per pay period, $2,000, that's $4,000 a month times 10. So we're at $40,000 year to date, give or take. I know the number's a little off, but he still got 2 months left to work.
That's right.
All right, so based on the information provided, it looks like you or your spouse annual income from this job is $52,000 this year. Is that correct? So they're calculating on the money. And this was my math. So my math was off by, about $2,000, but hey, we're gonna say yes. $52,000 is the amount that it looks like he's going to make. Enter taxes paid per pay period. So taxes paid per pay period is $131. Per pay period is $131. That's what I put. Enter taxes paid year to date is $2,500.
And guys, keep in mind, this is why it's so important to have a paycheck stub in front of you. If you're wondering why we're kind of scrambling just a little bit, it's because we had to come up with the example ourselves, because we don't work jobs. But if you work a job, you have to have your last paycheck stub in front of you, and you'll be able to go through this really, really smoothly.
Absolutely. And I'm gonna fill it out for the typical person. This person is not adjusting contributing to the 401k, the cafeteria plan, no bonuses, none of the above. So we'll check none of the above on this one. And then the second income source. So we'll hit that plus sign, and this will be referring to the queen. We're gonna say that she has an hourly job as well. Do you want to take it away from here?
All right, select what best describes when you and your spouse earn income from this job all year. How frequently are you paid? We're gonna do twice monthly. All right, using you or your spouse's most recent pay stub, when did you or your spouse most recent pay period end? We're gonna do the same thing, right? The last Friday in September. Do you or does your spouse have any other sources? Oh, I skipped. Select the option that best describes you or your spouse's current situation. We're gonna go with me and my spouse's last paycheck was a good representation of how much I or my spouse earn on average each pay period. Wages per pay period, we're going with.
All right, wages per pay period. So about 5,000. She earns about 5,000 a month, give or take. So we'll shave off. So we'll say that she earns about 4,800 a month, so that'll be 2,400 per pay period. So we're gonna do 2,400 per pay period. Wages earned year to date is the month of October. So if she earns about $4,800 a month, then that'll be year to date. Subtract 5,000. So she's about at 48,000 for year to date. And based on the information provided, it looks like your spouse's annual income from this job is $62,400. So
change this one right here, babe. Change it to 41.
Okay, we'll change it to 41 to make it line up with more like the 55. So yeah, we'll do that. Perfect. So 2,400, 41,000. So about 55,000 is about what she'll earn. Is that correct? Yes.
Enter taxes paid per pay period, okay? So for her, $156 is what we got, and year to date, we did 3,000. Select any that apply, and we're gonna leave these blank, so we're gonna do none of the above. Does you or does your spouse have any other sources of income? Y'all, it's the feds. They wanna know everything.
Everything they want.
Okay, I don't have any other sources of income. Let's say the job is their only sources. Hit next.
Yep, they want to know. Next, you're going to see crypto on here. So just get ready because they got investment income, self-employment income. They want to know. All right, adjustments to income. It says most taxpayers don't have a large enough adjustment to have a significant impact on their tax obligation. All fields marked with an asterisk are required. Select any adjustments to income you plan to make when you file your 2021 income tax or go to the next step. So we're going to leave these blank because I want you to just get an understanding. And we don't have any adjustments to income, so we're going to leave these blank and go next.
All right, so next we have deductions from income. And it tells you deductions reduce the amount of your income subject to income tax. You qualify for the standard deduction. So y'all see that same thing popped up. The standard deduction, according to the numbers that we've put in thus far, is $25,100. You're only going to itemize. This would be a good example if you had a small home-based business, like my econ, for example, and you have more than $25,000 in deductions. In this case, they are only working a job, so they're not going to itemize. We're going to take the standard deduction.
Absolutely. If your itemized deductions are less than your standard deduction, the tool will use the standard deduction automatically. So we'll just hit next.
All right, now tax credit. Tax credits are amounts you subtract directly from your tax obligation. And as y'all can see, child and dependent care credits, foreign tax, educational, retirement, homeowner, elderly, business, and alternatives, okay? They did in this example have 2 children, okay? Ages 7 and 10. What does it say? Enter the age the child will be on December 31st.
Right, so this right here is dealing with the dependent care. So we're not gonna, in the initial example, they did have daycare expenses, but we're not gonna enter that because we wanna get you to the end so we can give you some more goodies towards the end. But typically, if a person had dependent care, this is where they will go. So we will leave it blank in this example. The first example, you got a dose of how they look and how they played out. So we'll leave these blank. But as you can see, it's quite a few different things that could contribute to them having tax credit. As you can see, foreign tax, educational, retirement, homeowner, elderly, business, alternative, and then energy efficient vehicles. So we're at the tax credit section, and now we're at the results. So on this one, matter of fact, let's go back to the child because I just thought about something. I'm gonna go back to the child area because I want y'all to see what the adjuster tool looks like.
Okay, so we're gonna go ahead and put that in?
Yes.
Okay, so the age that the child will be December 31st, we'll just go with the ages 7.
Yeah, they had 7 and 10.
7 and 10, Child and dependent care credit, enter the number of qualifying children for the child and dependent care. If you are unsure, click that little question mark, okay? Enter the amount of qualifying work-related child care expenses.
All right, so in the example, they had 6,500.
Yes.
So I'm gonna just keep that same 6,500 and then scroll down. Enter the amount of children that qualify for earned income tax credit. The limit is 3, so we're gonna put 2 here. So some of this does include none related to child care, so I'm glad we did come back here. So we'll just leave that there. Adoption tax credit, we'll leave that blank. Then we'll go to next and see what changes.
And guys, did you see how easy it was to just go back?
Yeah.
Nothing is set in stone until you've actually printed this off and submitted it to your employer, which we have not showed you how to do that just yet. If you, now we're not telling you to fabricate anything whatsoever. We do not recommend it, y'all. This is the IRS. We don't play those type of games, okay? So you wanna be truthful, you wanna be honest. This is just a rough example, okay? But if for whatever reason you left something off, you were unsure about something, all you gotta do is go back to that section.
Yep.
And it'll take you back to that screen and reconfigure your results. So it's really, really easy to navigate.
Absolutely. And this is the beauty of this calculator, because it takes you to this results page, and now you'll see it's an estimated overpayment, also known as a refund. So the expected tax withholding was $7,222. The anticipated tax obligation was $4,000. If you do the math, the difference is $2,813 that they would get in the form of a refund. So if you see this gauge here, it says, are you gonna owe? Nope, it's way over here to the refund. So you don't have to worry about owing in this scenario. But this is where it gets fun, and this is the Queen's favorite part, so I'll let her take it away.
This is my favorite part. So after you get your results, you guys, so you see, it showed that they are entitled to a refund. If you owe, then the gauge is gonna be on this side, as well as the number will be in red, okay? This one is in bold. So I wanted to point that out. When you scroll down, it asks you, are you happy with your results? Then you don't need to do anything. Want to adjust your results? Use the slider tool below to select the approximate refund amount you'd like to get. Their estimated refund was $2,813. Check this out, guys. The IRS is the GOAT for this one. Take this little tool and you can slide it. Now, see, they're not letting you go past this line. Reason being is because we're already so late in the year. Okay, so the refund at this point is at the $2,813. If you decide for these last 3 months of the year, and you know people are going to make this decision kind of based off the holidays and stuff like that. If you decide, no, I want this money dispersed in my last 3 paychecks for the year or the last 3 months of the year, slide this adjuster tool all the way over to 0. That means you will not get a refund. Keep in mind, this is the refund that we're talking about. You can get it throughout the year. You can get it during tax time as you typically would, or you can split it up. If you decide, in this example, I want my money now, slide it all the way to 0, and then look at what it says. Based on your inputs and current tax situation, this result is not achievable. Considering use the estimator tool early next year for a higher likelihood of achieving your desired refund amount. That is because it's so late in the year. So let's keep playing with it. If we take this adjuster and let's say we do it this way. I want a $1,400 refund, and the rest of it I want distributed throughout my paychecks. So you're getting basically almost half and half, a little bit over in the refund. Look at what the results are. For a refund of approximately $1,400, this is what you want to do, okay? Your first job, $52,000. To get your desired refund amount, you will need $2 with help from each paycheck. That is $129 less than your current tax withholding. Submitting a new Form W-4 resets your withholding to standard withholdings. If lines 3 through 4C are blank, your standard withholding is $118 per paycheck based on your filing status and income withholding. The recommendation for adjusting your withholdings to get a refund of $1,400 will be based on the standard withholding amount, not your current withholding, okay? So it's breaking that all down, and it even goes to show you, if you keep scrolling, how to adjust your withholding, okay? So literally, it's all here. When you print off that form, step 1, step 2, step 3, step 4, telling you exactly what to put on the paper form. The paper form is even listed here. Look at my cursor. That hyperlink takes you directly to the W-4. Scroll down. Let's talk about job number 2.
All right, so the second job is the queen. To get your desired refund amount, you will need $2 withheld. So when you adjust it, you're still going to get a refund in the form of $1,400. However, the other amount that would have been in the form of a refund is now going to be coming to your paycheck. So when they say $154 less than your current tax withholdings, you would have been paying $156, but that $154 is going to come back to your paycheck, each paycheck. So that's going to be, when you do the math, per paycheck, and I'm going to go back to the first paycheck. When it says $129 less, that's going to be a $129 pay increase per paycheck. If you do the math on that, that's about $258. And then on the second job, if you do if you end up paying $154 less per paycheck, that person the queen is going to bring in $308. So we got $129 extra coming in per paycheck.
$566.
And then $154 coming in per paycheck. So you did that, and all together times 2
is $566.
So together as a couple, if they decide that they just want to, get the rest of their money throughout the year and get that $1,400 refund, they're going to be bringing in an extra $566 as a couple together. Individually, I gave you the numbers, but we're going to stick to the $566 because I want to show you what to do with that $566, more importantly. But as you can see, $2 will be taken out of their paycheck. They're still going to get a refund, but they're giving themselves a pay increase of $154. And basically, the form will be filled out and turned in once you print it out like we stated.
And send it to your employer, okay? Turn it into your HR department. You guys, so when you see us blasting testimonies, because I know we have a lot of new members here, when you see us blasting testimonies on social media saying this person gave themselves a pay raise of $300, this person gave themselves a pay raise of $129, this is what we're talking about. It's because they were entitled to a refund and they slid that adjuster tool and decided, I want some of my money throughout the year. I don't want that lump sum at the end of the year because I can start putting that money to work. So for this couple, if they're giving a testimony together, they would say that they received a $566 per month pay raise on their job.
Love it. So this is where the power of the W-4 comes in. I told you that we were going to talk about how the W-4 form could build wealth. Right now, we spent a lot of time talking about the W-4 form, but now let's talk about how this form can actually help you build wealth. Think about what all can be done with that extra $566. They can pay off a lot of debt if they had any. They can save more. They can put it partially towards lifestyle, or they can invest it. And I want to talk to you about the investing angle. So I'm going to pull up a tool that's available to everyone who has a My Econ membership. This is the tool inside of the back office. It's a part of the cash flow manager. And I basically pulled up the periodic monthly investment tool. And basically all I did was go to the back office, click on tools, and I chose periodic monthly investment. But just because we're pressed for time, I want to make sure that you understand the numbers because they get an extra $566. So let's just say that they invested it all. Of course, we know they can do other things with it, but we just want to talk about investment because I want us to be putting money towards assets and investing more often as a team, as a culture. So that way we're building wealth, getting out of debt and doing things together. So this extra cash flow, $566 monthly investment amount. And where did it come from? It came from the W-4. It was being overpaid in taxes, but now they're like, you know what? Let's see if we can build some wealth with this. Now, a lot of times when we talk about interest rates, some people think that getting 10% is just this big astronomical number. So they settle for like 2%, 5%. And not to say that 10% is bad. Getting a return on your investment is better than anything. And 10% usually outpaces inflation. But in this example, I am going to use 10%. So say that they put it somewhere and they were able to get a 10% rate of return. They didn't put it in the bank. They decided they wanted to open an investment account with Fidelity. They wanted to open an investment account with T. Rowe or Charles Schwab or Webull or even something like Acorns or even investing in Cash App. But they did their research, did their due diligence, and they put their money in a place that they felt would yield some type of rate of return. And let's just say that they had an interest rate of 10% that was being compounded monthly. Now, this is the power of the W-4 tool. And I'm just gonna give a couple of different examples. I'm gonna start with 5 years. Let's say they did that for 5 years because they plan on having this job for, a decent amount of time. Let's say that they took that $566 pay raise and invested it for 5 years, getting a rate of return of 10%. What could that do for them? Let's calculate it. A monthly investment of $566 invested for 5 years at an interest rate of 10% will grow to be $43,000 in 5 years. All right, let's play with that number a bit more. Let's say that they did that for 10 years, because most people work a job for 30 years, sometimes 40 years or 20 years. But let's say they did that for 10 years, the money that they were once losing or would have came in a refund, and they're still getting a refund. So let's keep that in mind. But the money that was once going towards a refund, let's say they did that for 10 years. Same interest rate, just a different amount of years. If you do the math on that, a monthly investment of $566 invested for 10 years at an interest rate of 10% will grow to be worth $115,942.26, almost $116,000. But most people work a little longer than that. So let's put in 20 years. Let's say that they did this for 20 years, just investing money that they were once leaving on the table. You hit calculate. Boom, a monthly investment of $566 invested for 20 years at an interest rate of 10% will grow to be worth $429,000, almost $430K, 20 years. Now, let's bump it up to the amount of years that many people tend to work before they retire. Let's bump it up to 30 years. Let's say they did this for 30 years and they treated the money like they never had it. They were still living fine off the money that they were, earning initially. So they treated it like they never had it. A monthly investment of $566 invested for 30 years at an interest rate of 10% will grow to be $1.2 million. So a lot of times your wealth is wrapped up in the money that you're leaving on the table. We show you how to get it back in the form of a W-4. We show you how to get it back in the form of a tax deduction. We're not even talking about the tax deductions that come from having a home-based business, working your business. We're not even talking about the extra income you can add to this to fuel it if you're making business income. We're not even talking about the interest that you save when your credit score goes up, the interest that you save when you pay your debts down sooner than later. This is cash flow just off of strategy number one. That's it. We're not even talking about the other 4 strategies that bring you in money outside of the investments. So understand that. And we're just talking about 10%. I'm going to show you some other numbers that make 10% look like, okay, that's cool, but it's some other options out there. Queen, you got something for them?
This is the reason why it's so important, you guys, to think about retirement now. Some people say, oh, I'm too young to think about retirement. Oh, y'all are only in y'all 30s. Why are y'all thinking about retirement? Because I want y'all to hear me very clearly. Let's say you do work a job and you retire at the age of 60, right? That's the retirement age right now?
Something like that.
It's something like that, 60, 65,
yeah.
70. Let's say you retire at age 65, right? Nothing wrong with working a job whatsoever, but a job is not designed to make you wealthy, especially if you are not putting money aside for retirement. You guys, I think some people believe that when they retire at the age of 60 or the age 65, that they're just gonna drop dead. Okay, I'm being funny, but I'm not being funny at the same time. Guys, that's not how life works. I mean, some people, of course, might pass away, as soon as they retire, but y'all not thinking about living outside of when you're off of your job? If a person retires at the age of 65, if they live to age 75, that's just minimal, right? That's 10 years that bills are still going to be coming in. The bills don't just stop either because you're retired. You don't get like a waiver on all of your bills. Those things are still going to be happening. If you do not want to work until you die, you have to be planning for that. Now, let's do some numbers, okay? Because we talked about, go back. We talked about
how many years?
If you only did this, let's say for 5 years, $43,000 would be the return that you would be receiving, okay? $43,829. But if you are already making right now $50,000 a year, kings, queens, how long you gonna be retired? Not even a year before you go back into the workforce. You gotta get this. Change the number back to 10 years. Okay, $115,000. 115,942 to be exact. But you're making $50,000 a year. So your bills are at about $50,000 a year, right? Because most people are living paycheck to paycheck. Some people think Social Security is going to hold them down, but think about the 40-40-40 plan. You work 40 hours a week for 40 years of your life, and Social Security only giving you 40%. Kings, queens, you're used to 100% of your paycheck. What you gonna do with 40%? So let's do the math. 115,000, but you're used to making 50,000 a year. You'll only be retired for 2 years.
And this is a couple, so they're really only retired
And this
for
is
one.
a couple.
So they're really only retired for one.
1 year, and guess what? You're going right back into the workforce. These are the people that you see. Nothing against them whatsoever, guys. This isn't shade. Working at your local grocery stores, working at Walmart. They retired and went right back into the workforce. You are kings, you are queens, you are worthy of a fulfilling retirement. You've worked 30, 40 years of your life. Why would you go back into the workforce? So it's extremely important that you plan for that now. If you are not investing into some type of retirement account, your 401k, if you don't have an emergency fund, welcome to my econ. It's time for you to get on track. You're at the right place at the right time. Last quarter of 2021, you can go into 2022 with a solid game plan in all areas.
Yep, and it's never too late to recharge. Now, I'm gonna give you the example of the 30 years invested, but then I'm gonna show you something that's gonna blow your mind, because this is just a 10% rate of return. And I'm not here to say that, you know, any amount invested is promised. Right. I'm not here to say that any rate of return is invested is a guarantee. That's not here what I'm here to say. Because when it comes to investing, you can lose money. But if you do your research, you should at least be able to position yourself to at least know that you're investing in something that has a future. Because many times when you understand the things that you're investing in, you at least can scale it and tell that it might have the ability to grow. Now, I want you to be thinking as a long-term investor, not just I'm gonna put some money in and try to flip it in and get something out real quick. That's cool when you're trading and you understand what you're doing, but I want us to develop the long-term investment mindset, because once you understand long-term investment, what happens is this: you're not worried about the ups and downs. However, when the downs do come, what you do is you buy more, because it allows you to develop a bigger position in that particular investment. And we'll talk about that on future trainings. That's why it's important to come to trainings, so we can talk about different rates of return and you growing your money, things of that nature. So let's take it back to the 30 years. Let's take it back to the 30 years that they invested and put it back at the 1.2 million. Now, this is based on a couple. Now, if the money is invested a certain way, sometimes what they can do is take a percentage of this. Now, let's say they're retired and they have a $1.2 million portfolio. You can take a percentage of this and live off of it while your money is still in there growing. Now, it might not be earning 10%. You might move it to an area that's a little bit safer, but this can typically pay out, you know, say they was living off, say this paid out about $100,000 a year. It's not like it's gonna take $100,000 and deplete it fully, because it can still be in an account growing. That's another day, another training, and we'll, you know, cross that bridge when we get to it, to the point where this could allow them to experience a great retirement and still live off of the same amount of money that they were making, $105,000 together. And then when they implement all of the other strategies, they can get even more. Now, what I'm about to show you now is about the, you know, should open your eyeballs a little bit if you're not already investing. 10% is the rate of return example that I gave. I know I've done this before in certain areas, and they're like 10%, that's unheard of. I'm like, okay. You know, that lets me know that they either have been misinformed, they just don't know, or they just, you know, have, you know, most of the time it's just misinformation. But I want us to start thinking about what's known as ETFs. I've done a training like this before, but I probably will do some more since we got some new people coming in, because ETFs are known as exchange traded funds. Basically, it's like you're investing in the stock market, but instead of putting all of your eggs in one basket, you're able to buy a bulk of stocks. So it's a safer way to invest, especially if you understand and believe in the future of that sector. And I'm gonna show you some of the rates of return that some of these ETFs have gotten, and just kind of paint a picture of what's possible if you think about the future. You don't want to invest necessarily in just things of the old. Like right now, it wouldn't be a smart idea. This company doesn't exist no more, but if Blockbuster was selling stock, it wouldn't be a smart idea to invest in Blockbuster. That's VCR days. You know, we're in a whole nother streaming days. So you got to understand what you're investing in. Is it an ancient thing that's, you know, may not have a future? They have to really do some stuff in order to make a comeback, or does it have a future? And with ETF, it's like investing in a bulk of stocks. Some people do mutual funds, index funds, but ETFs is one of the things that I like. And as we get an understanding of investing a little bit more as a team, then we can start grabbing some of these things together, because we've been able to get some great rates of return off of this. And then later we might talk about some other things like crypto. And the only reason why I say that is because I would feel bad grabbing some crypto and not sharing it with you. It's a crypto I was looking at today, and in the last month or so, got a 300% rate of return. Now, that's not a guarantee or promise of every year that that's going to happen, but the rates of returns exist if you know where to look and you know when to buy. So let's look at some ETFs. I'm gonna just look at the ETF in the, let's say the technology. Let's say a technology ETF. All right, so if you see, and this, I'm on etfdb.com. I want to go back. This is etfdb.com. So I'm gonna type in technology, because technology has a future. Most people know that technology is here to stay. And I'm gonna just let's type on, let's just click on this one. I'm just clicking around with some industries that I believe have a future. This particular ETF costs $8.75 per share. And I'm gonna just click on, just because I know we've been on for a while, I'm gonna just click on performance. Let's see how it's been performing. It's one in particular that I'm looking for. All right. No, not that one. Dividends, valuation, expense ratio. Hold on, bear with me, because there's a couple of things I'm looking for. All right, let's go back. Let's go back. Normally when I do this, I have a couple of them pulled up, but all right. Type in a different sector. I'm gonna type in gaming, because gaming has a future. A lot of people are playing video games, and definitely they're getting scholarships because of it. It's a lot of things, a lot of action going on in the gaming industry. So let's click on this. This one has a price of $29. That's basically the per share price. And let's see if I can find what I'm looking for inside of here. So hold on real quick. All right, perfect. So in this example of this one, this is the performance. So in the past year, this gaming ETF is called BETS. In the past year, the return has been 38%, a lot more than 10%, 38%. So the 10% number is doable. And this is in the past year. I want to find some other ones, because I pulled up some great ones that I can't think of right off the bat. But let's go to another industry. I'm gonna type in robotics.
He is pulling out the big guns tonight, y'all.
I'm pulling up robotics. Just think about where technology is going. So gaming is, you know, it has a future. Robotics has a future. So I'm gonna type in robotics. This one is known as Robo. It's up to $62 per share. So let's just kind of look at the performance. All right, so they actually have a little more history. So 1 year return, 29%. The 3 year return has been 58%, but over the past 5 years, it has been over 124% rate of return. So a lot of times people are like, you can't get 10% a year. Look at these ETFs that are getting great rates of return. And of course you wish you would have got it early on, but that doesn't mean it doesn't still have room to grow. I honestly like to catch it before it runs off, you know, to the speed, but you want to do your research, and we'll do some more trainings on that. But over the past 5 years, it's created 124% rate of return. Now I'm gonna do this one time, and I'm gonna show y'all some other numbers as well. But, and then we're gonna wrap up, I promise you. So the example that we gave was 10%. We're gonna wrap up and see if anybody has questions. The example that we gave was 10%. Now, in this 10% example, for 5 years, it would have yielded a person $43,000. But let's say we were invested in Robo for the past 5 years, where their rate of return in 5 years was 124%. So let's say you got the income shift, you did, as a couple, y'all brought in an extra $566,000, you invested in something like an ETF. And just so you know, the ETF, basically, I'm gonna show you the breakdown. Before I show you the numbers, if you click on the holdings, it lets you know what companies it's investing in. Some of them you may be familiar with, some of them you don't. But if you believe in the industry, how ETFs works is they pick out what they feel are the star companies and they add them to their ETF. If the companies that they chose or some of the companies stop performing at the level that they want them to perform, meaning getting the rates of return that they want them to get, then they can kick them out and replace it with a new star player. That's the beauty of it, because they don't want any weak links on their team, because they want people invested in the ETF. So you'll see some of these are iRobot, that may be familiar to you, Brooks, Rhythm. Some of these are Greek to me. I have no clue of what they are, but I'm gonna show you some that may be a little bit more familiar to you. But this is where you find the holdings, and these are the top holdings that they have. Now, as we saw, and just so you know, I ain't making up anything, the past 5 years, they got 124% rate of return. So let's go back to the calculator. The interest rate compounded monthly, and say over the past 5 years, 124% rate of return for the past 5 years. If they invested $566, when I hit calculate, let's see what it'll be.
Woo.
Almost $2 million. At the 10% rate of return, for 30 years, they got to 1.2. But if you're investing in the right vehicles, your money can grow quicker. Now, this is not a guarantee. And I'm not a financial advisor, nor do I play one on TV. I don't have a Series 6, Series 7, but I'm just starting to pay more attention to certain things in a way that I feel like we can deliver it to you, so we can all be building wealth together and understand how far certain money can go. Then this is 566. Let's say that they didn't even invest the whole 566. Let's say that they invested half of it. They splurged half of it, changed their lifestyle, but they just invested 250 instead of the 566. Now, it's power and compound interest, so the whole 566, I almost got them $2 million in 5 years based on that. Now, of course, everybody won't pick that, good of a stock or ETF, but I just want you to know the possibilities. But $250 invested at that same rate of return is still over $800,000. And they splurged with $250. So this is why you got to give your money directions, why you got to give your money instructions, because if not, you're spending it on things that are liabilities when you're leaving rates of return on the table that can happen at a decent pace if you're invested in the right area. But we're going to take it back to the 566, because I'm going to, show a couple more examples, and then we're going to open up for questions. I promise. I just want to, kind of, expand your mind a little bit. And this may be a refresher for some if you're already into investing, etc. But right now, or a lot of us, we communicate on social media. Let's see if, let's pull up a social media ETF, because they have an ETF for just about anything. So you see this one is a SOCL, short for social. I'm gonna click on that one, Globalx Social Media ETF. Let's see what kind of holdings they got. I'm gonna click on the holdings before I click on the rates of return. No Facebook in there, Snap.
Ooh, Twitter in there.
10 Holdings, I wanna say they have some involvement with TikTok.
Spotify.
So that's a whole nother thing. If they got some ties with TikTok, TikTok is rapidly growing. Alphabet, when you see Alphabet, that's Google. So understand that. Twitter, Navia, Match, Yadex, Keiko, Net, Spotify, Pinterest. So you recognize some of these. All right, let's see how they rates of return have been, because people have been using. Okay, this particular stock is $60. So it's gone up since the last time I did a presentation or a training on this, I think it was in the 40s, it might have been 50 something, but it's gone up since then. So these are the holdings. Now let's look at the performance, because people have been using social media pretty heavily for the past 5 years. All right. So 1 year rate of return, 21%, more than that 10%. 3 year rate of return, 98%, almost 100%, almost would have doubled your money. 5-year rate of return, because it's been growing, 138%. You don't even want to see me put the number. I put in 124 and it was at 2 million. You don't even want to see me put that number in the calculator. And I'm gonna be honest, these are still great numbers, but I've seen some, and we might stumble up on some because I'm gonna put in a couple more examples. But as you can see, if you're putting your money in a vehicle that can allow it to grow and you're taking this extra cash flow, you can really build some wealth. And it all started with a W-4 form. Don't let anybody tell you that you shouldn't touch the W-4 form, because I promise you, if you just wait on the refund solely, then it's a good chance you're not going to even be investing it. You're going to get that refund, you're going to put it towards something else. But if you make investing habitual, then I promise you, it can change the grand scheme of things. Even if you're not investing the whole amount, like I stated, we took half of the 566 off and just did 250, and they still were in a great place 5 years later. So I'm gonna type in two more things two more industries that's growing. There's so many more that's growing. Think about solar, think about artificial intelligence, think about cannabis, think about all of these industries, and you determine, okay, do I believe in the future of it? Think about 3D printing. Yeah. So these are some industries that have a future. So I'm gonna type in artificial intelligence. I'm gonna just see if I can type in AI. Okay. All right, so we're gonna click on bots. Bots, I've checked out both of these, but I'm gonna click on bots, then I might go to the IRBO. So we're gonna click on holdings, and then some of these you may recognize, some of these you may not. NVIDIA, most people recognize that. Upstart, you may recognize that. Intuitive, you may recognize that. Some of these are foreign companies, but nonetheless, let's see what their performance has been like. 1 year, 25%.
Awesome.
3 years, 63%. 5 year, 135%. 10% ain't sounding too favorable right now, I'm sure. Let's keep going. That's artificial intelligence. I'm gonna type in the cannabis industry, if I'm spelling it right. All right. I got YOLO, Toke. We're gonna type in Toke, because I actually have some of this one. And this one has a future because
it's only $13 right now.
It's only $13, so that's something to consider. And when I first grabbed some, I think it was a little less than that. But this is something that I look for as well. Let's look at the holdings. You might not be familiar with it, but Tilray is a major thing. And some people invest directly in Tilray, which you can. But if you want to invest in the whole industry, you might want to consider an ETF. Yeah, it may be a good stock that has done well and performed, and you may hit some home runs and pick a great stock. But if you're not the type of person who's always looking at it, consider doing something like an ETF, so that way you can be invested in the whole industry. And some of these companies aren't just about the cannabis. Like if you look close, some of these may be dealing with the soil. You see Miracle Grow right here, because that plays a part in the cannabis industry. So just think about all of the things involved in the industry. You might invest in one thing, but miss out on the fact that soil is actually going to be profitable for the upcoming years as cannabis begins to grow as well. So let's look at the performance of this one. And this is something I like to see. So the 1 year is 27.8%. They don't have enough history, enough data for the 3 years. They don't have enough data for the 5 years. But if you think about the last ETFs that I showed you, this one was pretty high, 80 plus. This one was over 100. I wanted to get in on this, so I'm gonna be putting more money into this, because I believe that in 5 years, Canada's would have spread even more. More states would have started to, release some of the mandates on it, and a lot more people will be approving of it. So I want us to be a part of that. And this one is only $13 per share. So you might want to write this one down. And when you write this down, what you want to write down is the stock symbol. So that the stock symbol is TOKE. TOKE. And I'll end with that. We'll do a whole nother training as it relates to ETFs, but I just want you to understand the power of taking something as simple as the W-4, where we showed you how going through the W-4, using that slider, they'll get a refund and keep some of their money. You're plugging it into the system and just estimating what the likeliness of a rate of return is that you'll get. And if you have a cash flow strategist, all of this, can be put in there as well. And you investing it in something that can grow. And this lets you know right here, if a person was able to grow their money in 5 years, and you know, faster than a person who might have been investing at a low rate of return for 20 years, 30 years. This lets you know right here, retirement is not based on age. So yeah, we said think about retirement, but don't think about it as if you have to be 65 years old to retire.
Preach.
Don't think about it like that. Just get in the motion of investing, and you may realize that your job just became an option versus something you had to do long term. So just keep that in mind. So I'll conclude. I'm gonna shout the other the team members out one more time, the Queen will, and we're gonna open up for questions because I see some of you are still rocking with us. Some probably had to leave because we, you know, went a little 30 minutes over, but we still got some people rocking with us, and we want to take any questions about anything that we covered tonight. Of course, much more to come in the upcoming weeks and months.
Okay, baby, do you want to stop the recording before we take questions and shout out the members? Or
yeah, we can do that. All right, so we'll stop the recording. This concludes the royalty movement training. You see, we live in a world where we're conditioned for failure, and oftentimes we are programmed or fooled into mediocrity. So people find themselves living like peasants instead of the royalty that they were meant to be. But you see here in the royalty movement, we see the king in you. We see the queen in you from start to finish. Is this time to take your seat on the throne? Because this is where we uplift your character, your confidence, and your cash flow. As royalty, you should establish a solid financial foundation that will soon lead to your abundance and thriving empire. Take your seat on the throne. You are royalty.
All right, guys, hang on if you have any questions. Also, I want to